Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Fall Webinar Series. This program is entitled International Tax Planning in a Post-Pandemic World. For those who don't know me, my name is Jonathan Shenkman and I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between the client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 to 25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Today, we're privileged to hear from Leo Parmegiani and Christopher Migliaccio from accounting firm PKF O'Connor Davies based in New York. Leo is a tax partner at the firm and has over 30 years of experience in public accounting. Leo heads the firm's international tax practice, is a member of the firm's Tax Leadership Committee, and is a chairman of PKF International's Mobile Individual Tax Committee. He has worked extensively with high net worth individuals, including United States taxpayers living abroad and foreign nationals living in the United States, and advises foreign groups in establishing domestic business operations. Leo has years of experience in cross-border tax structuring, transfer pricing issues, and tax examination representation. Chris is a senior manager focused on international tax. He works with both large multinational and startup businesses on tax planning and structuring, where he manages the development and implementation of transactions, as well as complex compliance and audit projects. Chris writes and speaks extensively on international tax issues relating to tax reform. Today, Leo and Chris will be speaking on international tax planning in a post-pandemic world. And with that introduction, I'll now turn the program over to Leo and Chris.
Well, good morning, everyone, and thanks for joining us today. And thanks, Jonathan, for this opportunity to speak on this timely subject, international tax planning in a post-pandemic world. As introduced, my name is Leo Parmegiani. I'm a tax partner at PKF O'Connor Davies. I'll be presenting with my colleague and international tax expert, Chris Migliaccio. When Jonathan asked us to speak way back in August, we thought, well, by December, we'd certainly be in a post-pandemic world, and definitely big tax legislation will have already been passed. I know we'll discuss how the new tax law affects international business, how the new higher tax rates and the elimination of popular tax planning techniques will affect certain taxpayers. And maybe we could mention how late planners missed the boat on lower tax rates, or how the new cross-border rules changed the international tax landscape once again. We could talk about how we should advise our clients now that things were back to normal. We also assumed back in August, we'd be moving on from travel restrictions, potential lockdowns, possible economic upheavals that we're seeing, particularly over the last few days. So of course, we now know that nothing could be further from the truth. Sweeping legislation still in Congress. And although a bill was passed by the House of Representatives, there's no certainty when or if significant changes will be passed this year, next year, or even into the foreseeable future. So I asked the question, are we really in a post-pandemic world? The events over the last week indicate otherwise. So it's possible that we may see more economic and tax relief on its way. It may be considered because most of the COVID tax relief provisions have long expired at the US federal and state level, and also other countries around the world. And what seem to be temporary work arrangements may be here to stay. People are becoming way too comfortable working at home, as we all know. As I am now actually today, and in many cases are actually more productive. In addition, as we're seeing with more global competition for talents and talented people, companies are hiring qualified individuals, no matter where they live, desire to work, and no matter what the tax consequences are. I think we're all, as professionals, experiencing that. International organizations like the OECD have developed strategies to allow for transparency, reallocation of profits, and enhancing the tax base to include such items as digital products and sourcing revenue by where the customers are located, and not necessarily where a company has a physical footprint. And the OECD countries have also agreed to a global minimum tax rate the 15%. I'm sure we've all heard about that. And the US may not be far behind, but whether we get Senate ratification is another question. All this sounds simple in the international world, but there's a lot of work that needs to be done, particularly with the OECD. One of the key issues with the BEPS initiative is how international disputes will be arbitrated and negotiated. There's no agreed upon standard at this point, and that'll be evolving over the next year or so. In addition, US states have become extremely aggressive in applying standards for what is considered doing business in a state where what we call nexus is created, where tax returns are required, and the new compliance procedures that have bombarded us over the last year or two. At my firm, we've seen tax audits being ramped up. Tax compliance has become time-consuming, costly for us, and now I'm sure we all agree that we're now starting to pass it along to our clients. So where do we stand today as tax advisors? Well, in my view, we need to be diligent, we need to be well-informed, and we cannot rely on our many years of gained knowledge. You know, my gray hair will tell you that I got many years, and right now it's way over 30 years. So I may have to adjust that in my resume. We believe that we need to perform objective reviews of where our clients stand. And even if we advised them previously on a transaction or a structure, we must determine what exposures exist, especially for succession planning and exit strategy. Because what we don't uncover today with our own review will certainly be discovered during tax audits or a tax due diligence process or procedures. Chris and I are involved in a lot of tax due diligence, and the biggest issues we're seeing today, and almost on every engagement of companies, particularly small to medium-sized companies, is they're not complying with state and local tax rules. And if they have any international operations at all, there's definitely exposure that we're identifying. If it's a U.S. company that's doing business overseas, it happens all the time. If it's a foreign company that's being acquired, they may have exposure in the United States even. So this could affect the values of the companies and their ability to sell. We've seen tax issues being deal breakers on many occasions. So other than what's changing in the post-pandemic world, we believe that the tax world has changed indefinitely. Our lives have changed indefinitely, the way we work and the way we deal with our clients. So if there's one word of the day in the tax world, I would say it's uncertainty. So as just a prelude to what Chris is going to say, we need to be prepared so our clients are prepared. I'll now pass to Chris Migliaccio, who will get into the big picture permanent establishment issues, OEC BEPS initiatives, and state and local tax exposure areas. So with that, I'll pass it along to Chris. Chris?
Thank you. Just to pick up, before I get into this sort of specific issues, I think one overview thing to pick up on what Leo said is that the biggest flip that I think we need to make as international tax practitioners, and certainly as an international tax practitioner, I've been sort of working on making that flip over the last several years, is really changing our perspective on what clients are international tax clients. I think for a long time, because the way the rules worked, there was a sense that, again, that clients that weren't particularly large companies or didn't have didn't have necessarily big operations outside the U.S. were going to be safe. And I think what we're going to raise here are some issues to consider and things to think about when you're advising clients, things to keep an eye on. Again, maybe if you're not a tax practitioner, maybe you're advising a client on something else and you notice something, say, hey, maybe you should really talk to an international tax person about this. Because there's potential issues here. And again, maybe it's nothing. Maybe you talk to them and find out, okay, it's fine. But just to raise these issues so that you can help spot them and get a sense of what the potential issues that are out there are. On any of these issues, we could talk for several hours. So we're going to keep it to sort of a high-level overview and just kind of give you that lay of the land of things that are sitting out there that are causing problems for clients. So the first one, permanent establishment. What a permanent establishment is, if anyone's sort of unfamiliar, it's just the concept that it's a fixed place of business where a business is wholly or partly carried through, including generally like an office or a fixed place of management. And what this generally affects is, let's say I'm a US company and I open up an office in London. I actually get myself a physical office space. it's likely that I'm going to have some UK tax consequences to that. The issue, of course, now is that who on earth would spend money opening up an office in an expensive London tower? If you want to hire someone in London, you just hire someone, right? And unfortunately, again, the rules on these issues haven't really evolved in a lot of ways. And so we need to think about how they work in the context of a global marketplace where talent is getting hired pretty much without regard to location. So you could have a permanent establishment if you've got a key employee in a foreign country. So we see this a lot with like a CEO or a CIO who's getting hired elsewhere. Or if you have a number of back office employees in a foreign country. Let's say you've just decided you're sort of building up your team and you happen to do it in one country, that's a real potential issue in terms of developing a permanent establishment. You might say, because Leo and I presented on similar topics about a year and a half ago to the same group, weren't there exceptions for people stranded because of COVID? There's exceptions to this. We're still in a pandemic world. How can anyone be held liable for this, or how can this be a concern? The first thing is that the COVID exceptions were, generally speaking, very limited in duration. Any sort of codified exceptions that were put into place by countries lasted a few months at most. The second thing is, it's just sort of broadly, if you look at sort of the OECD guidance about sort of treaty protections, just generally on these issues, everything assumed that changes in work location were going to be exceptional and temporary. And as remote work arrangements become permanent, it's starting to lose the argument that it's temporary, right? When people get hired and there's no expectation that they're ever going to move from Canada to the US or from the US to the UK, it's starting to look like, yeah, these are permanent arrangements. Hence, you might have a permanent establishment, right? You might have some particular income tax issues in the countries that you're hiring. So what happens if a business has a permanent establishment? The main issue is that they've got a responsibility to file income tax returns in that jurisdiction and allocate profit to it. So if you've got a US business that hired their CEO in another country, that other country would say, look, you're operating, a key part of your operations are happening here. Some part of your profits should be allocated here, and you should be paying income taxes. There's also payroll tax returns that are going to be required if you've got an employee in a jurisdiction outside the US. And payroll tax, actually, it's interesting, is sort of a red herring, though. Because a lot of times we'll come across clients say, well, we've hired someone in Brazil, but don't worry, we've got an employer of record in in that country, like a PEO, and they're going to take care of the payroll tax. And so that's great. That's good sort of forward thinking to make sure that you're not avoiding payroll taxes in a non-US jurisdiction. The issue is that the payroll tax, the fact that someone is covering payroll tax for you, does not necessarily cover the income tax issue. And the other option there, because again, you can't, generally speaking, can't have a PE if someone's not an employee, if they're an independent contractor. So a lot of times what we hear is, well, I'm just going to hire them as an independent contractor. Leo and I had this conversation with someone earlier this week. They said, look, we want to hire our CEO in Australia. She's great. Well, is she going to move to the US? Because this was a US based company. I mean, she might eventually, but for the time being, for the foreseeable future, she's going to work in Australia, and there's no concrete plan for her to come to the US. Well, okay, well, sounds like kind of an issue. It's like, well, don't worry. We're not going to make her an employee. We're going to hire her as an independent contractor. And the issue is that if that ever were to get audited, they'd get laughed at, right? Because there's specific rules, concrete rules about whether someone, at least for tax purposes, is an employee or an independent contractor. And so if someone's hired as an independent contractor on paper, but they're really an employee, Australia would say, no, you US company, you have a permanent establishment in Australia. I don't care that this says that they're an independent contractor on paper, they're an employee. And And this is where, again, this is something that comes up on deals a lot now. We're finding this to be very frequent where you say, okay, well, do you have any employees outside the US? Do you have any workers? Do you have any people providing services to you outside the US? And we get that answer. Yes, our CIO is in Canada. Yes, our chief marketing officer is in France. It's going to become a very common answer. And it's a real roadblock on the path to finishing a deal, because the question of have you filed all tax returns is clearly no. It's clearly incorrect, right? And so that's something where, and again, I don't want to be a fear monger here, right? I don't want to say that this needs to be a total deal breaker or it's going to ruin a business. But to the extent you can be out having those conversations initially with clients, as they're making hiring decisions, they can make the determination of maybe I need to set up a subsidiary in that country, or maybe I need to make plans to allocate income in a certain way to that country so that there's avoiding that issue. The more a client can be doing planning in advance, thinking about these issues ahead of time, that's really what you want. You want them to not be blindsided by this issue on diligence when they're trying to sell their business, especially if they're a startup. And that's a lot of times where you see this issue is in the startup space, where they say, well, why wouldn't I just hire someone? I work from home in the US. Who cares if they're sitting in France or Canada, as long as they're available to me? The other one, actually, interestingly, that we've seen is a couple of places where there's been a mass of people in a specific country. We've seen a situation with 40 people in the Philippines, even a situation where it was a Canadian company that had people providing services in the US and said, well, okay, independent contractor, and said, no, they're employees. In fact, I had like a leg on my face. So I was like, oh, in this industry, it sounds like these people would probably be independent contractors. And that the attorney doing diligence said, no, Chris, I know what you would think normally, but they work a set number of hours for a manager, and they take full direction. They can't work for anyone else. These are employees. And I was like, you are correct. I agree. And that almost blew up the deal, because the employment tax in the US that they had avoided for these 3 or 4 employees, which was probably enough to get to a PE, it's a little bit on the line, but there's a few employees you're starting to get to amass there, would have potentially been more than the value of the deal because of payroll tax penalties. So something to really keep in mind and be guiding clients on, that this is not, you can become an international business, not by the products you sell or by the way you're operating, but by who you hire. And you really got to be careful about that. Another thing we're seeing that comes as a surprise to a lot of clients is state and local tax issues in the US. So if you're a foreign company, right? And the common fact pattern here is, I'm a foreign company that has, let's say, a digital service that I sell to clients, right? I'm providing software as a service. I've got no one in the US. I've got no servers in the US. No one's ever developed. My employees never set foot in the US. The question becomes, do you have any issues with US tax? On the one hand, US federal tax, we would tell you, you're fine. You clearly don't have any kind of permanent establishment. There's really no risk there. You don't have anything connecting you to the US. The issue is that the US federally sources income, even for digital services, based on where the work is performed. So again, work performed in the UK, no permanent establishment in the US. States, though, and in the same way EU countries, I would point out, are thinking about this in the same way, are going the other way, right? They're saying, look, I don't care that your services are being performed in the UK. You're selling to customers in our state. And as such, we think we can exercise taxing jurisdiction over you if you sell enough to someone in our state. Big potential issue. I think a lot of people are aware of sales tax thresholds, the Wayfair case, which says if you're selling products that are subject to sales tax and you meet certain thresholds in a state, you can be forced to collect sales tax. And that's both the selling of tangible goods and certain digital services, right? Normally, I think we think about Wayfair in the context of, selling widgets, but there are certain states that are moving towards sales taxes on some digital services. That's very much a patchwork. And that's something where we advise clients on what exactly are you selling and what states are you selling into, and sort of take a look at that for them. The other thing that we're seeing come up a lot, though, is that digital companies, and also even, again, sometimes just companies that provide services where they just don't need to go to a client's office. They don't need to be present to help the client. Also need to consider economic nexus for income tax purposes, because a lot of states are implementing two things that go together here. One, they're implementing what's called market-based sourcing, which says, if I have a customer in New York, I'm going to source the sale of that foreign company to New York. I don't care that you did the service in the UK, the sale is a New York sale. And secondly, there's a bright line threshold whereby if you've sold enough into the state, you have a income tax nexus. Again, even if you don't have a permanent establishment, a lot of states, generally speaking, do not care if there's a permanent establishment or not. They don't have an obligation to follow U.S. international tax treaties. And so this is, again, happens to be a frequent surprise for companies where they realize, oh, we've really got to, and this is where our role as advisors is important, and on sort of ongoing business advisors, because sometimes we're dealing with startup companies and what we say to them is, look, you don't have a filing requirement right now because your sales are too low into the state. But are you trying to get bigger? And they're like, yeah, of course we're trying to get bigger. Okay, well then maybe next year you might have an issue next year. And this is something where we need to sort of constantly revisit these issues as a company changes and grows. I have one client where we advise them on setting up their US structure on an inbound thing because they were earning one type of income from basically sort of revenue from YouTube. And they're like, oh, by the way, we've totally abandoned that. Now we're a digital gaming company, right? And so with each iteration, we need to have different conversations with them because their business is changing and growing. That's what happens to a developing business.
Hey, Chris, it's worth noting that this doesn't apply to just international companies. So if you have a local New York company that is now expanding across the country, everybody's into digital sales, right? So we're talking international, but certainly local companies as well, right?
Yeah. Again, this is the most common thing on diligence is the first thing we say is, tell us how, like a lot of times we look at the federal returns, maybe we find a couple of points to talk about, but mostly we're saying, please tell us how you determine where you file state taxes. How do you determine that? And that's where there's huge deficiencies. The other one that's a real kind of hot topic for us right now is selling on Amazon. And this is, again, for an inbound company, right? They want to get their products into the US. They don't want to set up a distribution network. So easiest thing in the world is they say, we'll sell on Amazon. Amazon, generally speaking, takes care of sales tax for people who sell on its platform. Easy peasy. The issue is that the presence of inventory in a state generally creates nexus. What does Amazon do when you give them your inventory, which remains your inventory when it sits with them? They move it all over the country. So again, even for national business, but certainly for inbound businesses that are thinking, I've got no PE, I've got no concerns, the issue becomes, yeah, but you've got state concerns because you're selling a lot. I mean, again, this is sometimes a conversation. I wouldn't necessarily advise if you've got 5 pieces of inventory in Idaho and $10 of sales that you file an Idaho tax return. That would probably be a little bit too aggressive. But frequently the answer is, oh, we've got lots of inventory in Pennsylvania and $100,000 of sales into Pennsylvania. Well, maybe you should look at filing a tax return in Pennsylvania. I picked Pennsylvania specifically because they're one of the states I've seen the most notices from, where someone says, oh, you've got a third-party warehouse in Pennsylvania, you should be filing taxes. The last one, and this is kind of an interesting sort of a big flip, I think, and something that's still really evolving right now internationally, is that, one common aspect of tax planning, certainly when I started, which was, I don't have as many years in as Leo, but I do go back almost 15 years now. And that's that, one common aspect of international tax planning was efforts to move income into low or no tax jurisdictions, right? How can we appropriately shove some income into the Cayman Islands? The Cayman Islands won't tax it. And if we don't pay a dividend, there's no US income tax on it, and we'll effectively avoid tax for a long period of time. The other classic one, of course, was, the big digital companies, Amazon and Google, putting IP rights into Ireland and stashing money offshore for years. There's been a lot of work over the last 10 years to limit those things, right? Rules limiting deductions without corresponding inclusions or restricting the use of hybrid entities, that's killed a lot of planning strategies. In the US, right, we've been aware that there's been the global intangible low tax income, GILTI minimum tax. That made eliminating income tax on foreign income more difficult, but at the same time, one of the things about the GILTI rules, if you haven't been involved with them, is that you could net losses and foreign tax credits across jurisdictions, right? So it was very possible that you could have income in Dubai, but have enough foreign tax credits from your UK operations to wipe that out and not pay any US tax on your Dubai income, and still sort of gain at least some benefit from the fact that you had some operations in Dubai. The issue, though, is that the world is changing pretty quickly on that. So the BEPS project, the Base Erosion and Profit Shifting Project, the OECD, the BEPS 1.0 dealt with, again, those deduction, no inclusion strategies, hybrid entities. BEPS 2.0 is two-pronged, but the big one is a global minimum tax, right? Where the minimum tax is now going to be 15% even on offshore income. So the US tax is probably 10.5% at sort of minimum, but it's likely to move to 15%. More importantly, for companies that have already, because Leo mentioned at the top, right? Even if we've advised someone on a structure, maybe we've looked at their structure for GILTI purposes and said, actually, you're fine, you're in pretty good shape. Right? The rules in the US, which again, these are the rules with the OECD. So even if these don't pass as part of the tax bill right now, I think there's a chance they pass next year anyway. Foreign tax credit usage and usage of losses as well would be country by country, which means just because if I've got plenty of taxes in the UK to offset my income, if I've got income in that low tax jurisdiction, the US is going to tax it at 15%, right? My Dubai income or my Cayman Islands income is going to get taxed to my top company at 15%, which is a problem, right? This really might change the value proposition for operating in a lot of jurisdictions. And I think one of the things we have to work with clients here is really changing their expectations. I think Leo and I still meet a lot of clients who on the first conversation are like, well, you guys have some magic, right? We're just going to move some stuff over to the Cayman Islands, right? We'll make tax go away. And it's like, no, you're a US company or you're a US owner at the top. You're not going to make tax just disappear. The rules just don't work like that. And they're saying, is there any way? And it's like, well, would you like to give up your US citizenship and move to the Cayman Islands? And they're like, no. And they're like, well, sorry. That's basically the extent of your options, is you'd really have to uproot your life essentially. But if you're going to be living in the US or again, a lot of other, the EU, Canada,
Even Puerto Rico, right?
People moving Puerto Rico, so yeah. You're gonna face some of these issues. And I think it's something we've really got to work on educating clients and working with them and understanding as they're developing their structure. And as they're thinking about their business. I had a conversation with someone yesterday that's really at the beginning stages of their business, thinking about where their subsidiaries might be. And I said, look, throw out the idea of trying to get zero taxes on something. Think about where the best subsidiaries are for your business. And then we'll talk about some optimization, maybe by putting things in the same country, right? Because we don't necessarily want income to be in 3 different countries anymore if these rules get into place. So it's a really interesting time. It's really, again, I think the biggest thing is to really be thinking and looking for these issues and talking to your clients about them so that they're not caught off guard. And again, as Leo said, they're not found on during an exit. right? While they're negotiating and talking about how much they're going to get, they find out, oh, by the way, there's $1 million tax liability in Canada, and we've got to have an escrow. Yeah, so that's something to consider. I think that's all I have, Leo. Anything you want to add?
No, I was just going to say we're right on time, 8:59. Jonathan, we don't want to go over. So
Great.
thank you, everybody, for listening. If you need any help on international tax, I know there's a lot of CPAs, attorneys in the audience. I know you guys probably do a lot of this yourself. We can collaborate. We can work together. We can bounce ideas off each other. Chris and I love to talk about taxes, planning, structuring. So the more the merrier. Love to collaborate with people in the audience. And thank you for the opportunity, Jonathan. And
Great. Thank you
everybody.
so much, Leo and Chris. And again, if anyone has any specific questions or new business opportunities, you could feel free to reach out to Leo and Chris, and I'll make sure to include their contact information in the follow-up email to this program. So I tend to get a lot of questions about handouts. I sent the handouts and the reminder email to this program. They'll also be sent as a follow-up email tomorrow morning, so you'll be able to see the PowerPoint presentation. As I mentioned at the onset, the goal of these programs, stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we can all agree that clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 2 more quick items before I let you go. First, my next program will be on December 9th, and it's entitled Top 10 Considerations Professionals Must Know When Assisting Families with Special Needs. And it's featuring Amy O'Hara, who is a partner in New York-based law firm Littman Crooks LLP. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. With that, this concludes today's session. Please stay safe, healthy, and have a wonderful day, everybody. Thank you.
Thank you, Jonathan.